We are live, Portfolio Builder members. Welcome to the latest update. I know it's been a little while. Year to date, the S&P 500 is up 16% and we're up 49%. So we're doing very well. We went to a large cash position in the high risk portfolio and basically looking for a few things to happen before we redeploy that position, which we'll cover momentarily. But today there's no change. What we've been doing is predicting that inflation would fall and that this should drive interest rates lower and cause the Fed to pause, slow down forward guidance in terms of quantitative tightening, and even have the bond market start to price in some rate cuts. So far, we've been dead on in predicting the crashing inflation, but the bond market's still not getting a bid that we're expecting, and the Fed is still talking very hawkishly. So let's go over everything in detail. This chart is showing that the producer price index has been leading the CPI. And today we had a large drop all the way to 3% on the headline inflation and a beat, which was expected, and a beat on the core inflation, which was sticky. That was supposed to come in at 5, came in at 4.8 today. This chart's indicating we're going to go below the Fed's target here on the headline inflation in the next few months. Now, some banks are saying that this is the bottom and inflation is going to start coming back up in the coming months. And perhaps that's why the bond market is still being relatively stubborn and why the Fed's still being hawkish. But this is what we've been anticipating. And so we'll see what happens. Currently, there's a 92% chance of a rate hike in 2 weeks. But it really doesn't make sense. So now the risk is that the Fed over tightens and crashes the economy, creates massive unemployment. And if that does happen, your bond position is going to outperform everything under the sun. Now, if they do a good job and just ease up at the right time and interest rates begin to fall, our bond positions will still do well. So that's what we're looking at. Now, this is the services inflation relative to ISM services prices paid. This has been the sticky inflation. And again, this is the leading indicators pointing that sticky part in the labor market and the services sector should start to fall dramatically in the next few months. Also, the U.S. core CPI annualized is now below the target of 2%. So just really good inflation data coming in. And this is on the backdrop of strong labor growth last week. So we do believe there's likely going to be one more rate hike maximum at the end of this month. And then if we're correct and inflation continues to fall in the coming months, that they're going to essentially stop hiking interest rates, pause, and then start to cut rates in NQT. Another reason why we believe the inflation is going to slow down here and that there's a risk of overdoing the tightening is that we're headed towards excess savings being completely eroded by September. So that's going to certainly slow down the economy as people run out of cash from their pre-pandemic savings. Now, this chart's actually showing it going into negative into forward years. So everything's really lining up. Now, one thing that gave us a hint that we're going to have a good CPI print this week was we got China's data at negative 5% in the producer price index and 0% on inflation. And that's with their currency weakening, which is quite interesting. Another thing we know that's going to drive inflation down over the next year is the lagging effect of how they measure rent. So we can see there that rent inflation has crashed from 30% to 0, and now, oh, excuse me, that's for Florida. For US, it went to as high as 20% on the average, and now it's down to 0%. And again, that's a year of lagging data that's just now starting to pick up in the CPI, and that represents about 35% of the CPI. This is actually illustrating the lag in the CPI shelter compared to all items. So that shelter in place has been really driving the inflation up over the last few months. It's finally bending over and starting to fall. And again, our data shows that it should fall for the next year. Also, online goods, which were having a lot of inflation with everybody ordering stuff online. That's now gone into negative territory. So it's become deflationary, down -3%. So everything's looking good as long as the Fed doesn't overdo it and create a big layoffs. We believe we have Goldilocks situation coming up. This is also looking at the used car CPI versus real-time data. And that's showing about 4 months of falling used car prices to also help drag down the CPI. So, okay, let's look at our two portfolios. In the high risk portfolio, we have a teeny tiny UVXY position, probably need to top that up in the near future at 1.5%. That's our crash insurance. For every $4,627 invested, which creates 1 unit following our program, you have 4 shares of UVXY. Got a 15% position in bonds at 98 shares. This is leverage times 3 on the 20-year. So we're betting that long-term interest rates will begin to fall here. And typically that happens very aggressively shortly after the Fed officially pausing. We're not there yet. We're long the dollar against the euro just as a hedge against inflation coming back and as a kind of a placeholder until we reinvest that capital. So we sold FNGU at 159. A lot of you know it went up a little bit higher by actually quite a bit. But the valuations on those tech stocks are enormously overdone, in my opinion. So I'm waiting for Coinbase to catch up to the NASDAQ's return. It's actually doing quite well. And I'm looking for a pullback in the big tech companies before we redeploy that. Also waiting to get more aggressive in oil with NRGU. So this portfolio is now at 49% year to date, and we took a lot of the risk off, and we're waiting for a better entry opportunity. So just not being greedy in this portfolio. And also treasuries still remain very attractive and might be where we put some pretty considerable capital for the high risk portfolio. Now, this chart's showing 45% year-to-date return. I hadn't updated it to include July. We're up to 49% and sitting on a 2.75% return in July. Safe Growth portfolio has been betting heavily on bonds, and that just hasn't played out yet. So we're going to be patient and wait for that to play out with this portfolio. I really don't see any significant changes to this structure of this portfolio other than maybe topping up UVXY. Long term, we believe TMF can at least triple and plan to hold it until it does that for the Safe Growth. It's just been a little bit of a slow start for the bond market this year. EDC is going to do very well if interest rates fall and the dollar falls. That's really our big call over the next 5 years. So no change in that. EDC started the year out really well when inflation looked like it was going away. And then we had some sticky inflation come back and it crushed Asia. But again, no plans to change that position. GBTC has a great setup coming up into the election year. No plans to change that. And we've got a heavy inflation hedge with oil with NRG. So I really like the way this portfolio is currently structured. Only thing we might do is reallocate a little capital up to UVXY. So on the Safe Growth portfolio, each unit's coming in at $2,077. You have 2 shares of UVXY, 114 shares of TMF, 12 shares of EDC, 22 shares of the Grayscale Trust GBTC, and 1 share of NRGU. This portfolio is at 3.32% year-to-date return, slightly up, actually about 4, because again, I had to fix the year-to-date to include the July return. Had a great June, and again, if we keep getting these deflationary impulses, you're going to see that TMF position really explode. So I think it's going to catch up potentially to the high risk portfolio by the end of the year. Okay, let's look at some charts. Let me try to hide my little screen here. Okay, this is the 2-year bond, which again started off ripping up to begin the year, crashed into March, went right back up to its recent high, and starting to fall back. Okay, so we really want to see the 2-year essentially forecast that the Fed's going to pause and start cutting. And so far, it's been a very bumpy road for the 2-year this year. TMF, which is the long bond, continued the 2-year bear market for the long end of the bond market, down 17% year to date. It began the year strong, and it had a good run up back in April. And again, it's really waiting for the Fed to stop hiking interest rates and for inflation to continue to fall. So today's data was very good for the bond market. And again, if the Fed does a great job and they pause at the right time and don't crush the economy, this position should do very good. If the Fed overdoes it and tightens too much, which they have a track record of doing, this position will probably be one of the only assets that goes up outside of UVXY. And again, that would create a stock crash. Dollar index at the $100 level, falling from the high point when we had the invasion into to Ukraine by the Russians. So it's fallen considerably, and this can go much, much lower. We're again in the high risk portfolio long the dollar against the euro with EUO, but plan to get out of that as soon as we see a really good opportunity. Just looking at the yield curve, but broken down per interest rate. And you can see the 3-month is at 5.39, signaling we got another rate hike coming in. The 1 year is at 5. So again, right now we're in the 5 to 5.25 federal funds rate. Right now the market's predicting they're going to jump that one more time to the 5.25 to 5.5. And that's why that 3 months trading in that range currently. But the rest of the yield curve is saying that the interest rates are too high and are below. So we're still sitting on a very inverted yield curve. Now, an inverted yield curve is typically very bullish for about a year. And then when it steepens, that's when you want to get worried. So when the front end interest rates fall rapidly, causing the yield curve to steepen, which means the front end interest rates are lower than the long-term interest rates, that's typically when you end up with some sort of stock crash recession period. Okay, FNGU, you can see we sold a little early. We sold at 159. It went up a bit higher. These companies represent something like 30% of the S&P 500. And I believe the AI trade's been dramatically overdone. It's great tech, absolutely. But I do think there'll be a potential sell-off to get back into to these big tech companies. And if not, I would rather play something like the Grayscale Trust ETHE because it's not as overvalued, and there's a huge catch-up trade sitting there. So currently we have Coinbase for that. Here's Coinbase up 158% for the year. So we made most of our money in Coinbase and FNGU this year. GBTC is up 130% year to date. That's where most of the gains for the Safe Growth portfolio have been derived thus far. EDC started the year out really well and then crashed back down as the inflation and interest rates came back. But now it's bouncing back up, down 5% on the year. We believe this one can greatly outperform US markets in this cycle of interest rates falling and the dollar falling. Oil has bottomed out in the $80 range, $75 range, that is, and starting to creep back up. If we did see oil heading back towards 100 or even 90, I'd get worried that inflation's coming back. At this point, it's not having that type of price action. Here's NRGU, which we have a little exposure to in both portfolios. We have a larger portfolio position in the Safe Growth because we're so long bonds. Those two work well together as they typically react in opposite directions. There's a look at the 30-year, which again has a long-term trend of going down. We believe this cycle will end with it breaking to a new low, and that's what you're playing with TMF. So it's quite likely topping out here. Will slowly go down in a healthy economy with falling inflation. And again, when we get lots of layoffs in a recessionary type of environment, that's when we'd expect it to crash to new lows. We're not in gold, but we're keeping a look at it. Central banks have been loading up on gold, and you can see it's hovering recent highs. Silver not having quite the high as gold, as you can see, but tracking it quite similarly. UVXY continues to get crushed, and If we thought that inflation was going to return, that's our main fear in the market, then we would add to UVXY. We're so low on UVXY, we'll likely add to it regardless in the near term. Now, the regional banking crisis seems to be contained now, with KRE going back up from its lows and having a very strong few months. So we're not currently worried about the regional banking crisis. S&P 500 just locked solid, up 15% year to date. The NASDAQ up 38% year to date, led by those big AI companies. Russell 2000 up 8%. If we look at the economic data, this is quarterly data. We can see the US consumer continues to hit new highs. Balance of trade remains healthy. No signs of the US economy dying in any way, shape, or form. Retail sales have been rising the last 2 months. And consumer credit did take a dive in this latest print. So this is one of the more alarming data prints, which again points to some deflation coming through. US loans continue to grow despite all these crises. China's PMI is still above 52, showing China's PMIs are at least still strong levels. Chinese exports, while falling, are still at healthy levels, and Chinese imports also at healthy levels. So we don't see any reason to believe that there's an imminent recession and lots of layoffs coming, which would be what would cause us to sell stocks, cryptocurrencies, and go all in on bonds, the dollar, and UVXY. Okay, great. So that's our update today. If you want to learn more about our product, call Dean at 505-322-7515. I'll go ahead and take any questions now. But yeah, we're basically waiting for the bond market to react the way we're expecting before we make any changes. The high risk portfolio, I'm not comfortable buying FNGU at these levels. I would be comfortable buying the Grayscale Trust products or treasuries if we think that inflation is going to continue falling. If we think inflation is going to return, again, we're going to get worried about another risk off event because right now the market's really not prepared for return of inflation. At this point, I see no reason to believe that's the case. Okay, great. So at this point, I'll take any questions. If not, we'll see you back next week. Same place, same time. Yeah, I'm very, very bullish on ETHE. I would recommend buying Rebel dividends with that investment because you get, for every dollar, you're going to have $3 of exposure. So I'd rather have you get into Rebel dividends than ETHE. There's no SEC suit against Grayscale. They are being sued by a bunch of companies, and it's the parent company, not Grayscale. No, I don't think now is the best time to get more NRGU. We have a small amount in both portfolios that's appropriate. Again, I think that inflation is going to fall, not rise. So, and oil's not giving us that signal. Oil should be screaming higher with China reopening, the end of the SPR being dumped, and OPEC cutting production. So everything possible is going in favor of oil, and it's still not getting a strong rally. So I think the best assets right now are either crypto, if we're not going to have a recession, or bonds and UVXY if we're going to have a recession. At this point, I have no reason to believe we're heading into a recession. So I think cryptocurrency is probably your best returning asset. Ashok says, what's your opinion on getting back to Boyle? Boyle's had a nice few months, but it looks like the European economy has completely adapted to basically all of the Russian oil, gas being cut off, and now they have huge surpluses of it. So maybe we would put a small position if we thought inflation was coming back into Boyle and Energeo. At this point, I would rather go with the big oil and gas companies, easier to predict, much larger part of the economy. And the catalyst that was driving it, Ed saying, should we short the NASDAQ with the triple Q? That's not a bad idea, except that we think the macro is bullish for the NASDAQ. I just don't like the valuations. So I'm not really comfortable shorting the NASDAQ nor owning it right now. It could very well go to new highs. I just don't like the valuations currently. And I think right now the smart decision is to be a little patient, get another month of CPI data in, and then we can really make some more moves. But my best guess is we're going to be adding to crypto and bonds in the high risk portfolio. And I think the safe growth is pretty much set to jet. I don't really want to change anything in there. If I start getting leading indications that inflation is coming back, then I like NRGU, BOIL, UVXY. So if inflation's coming back, we don't want to own bonds or tech for that matter. We want to own the VIX and oil. But again, all data is pointing to a crashing inflation print. So I'm more concerned about whether or not they're going to overdo the tightening and crash the economy too hard. I think they need to stop raising interest rates and in quantitative tightening, or they risk crashing the US economy. Which is hard to say because we've had such a rock solid US economy with these unprecedented rate hikes. And again, if you want exposure to crypto, you can do ETHE, you can do GBTC, you can do Coin, you can do Riot, you can do Mara. Huge investment company owns 10% of Riot and Marathon now. But if you want the best position, I like Rebel Dividends because we're giving you triple leverage. So if you wanted something like the TQQQ, but for Ethereum, that's what Rebel Dividends is currently. And you can call Dean to get that position. Again, that would be me managing it. You wouldn't have it in your own brokerage account. Don says, what's the talk about the CBDC? Yeah, so all the governments globally are creating blockchain currency that they can control. It has no impact on cryptocurrencies. They're just stealing the technology and implementing it into government money. So it's, and for them, they want to be able to control who pays who, what you buy, shut down people's money that don't follow the rules and things of that nature. What it's not designed to do is replace Bitcoin or Ethereum. So yeah, so the reality is that would be something like when they want to do stimulus, they can just bypass the banking system. You just go register with them and they deliver you your tokens, and it works in the US banking system. Yeah, it's very viable. It's basic blockchain tech that we've been watching all the stablecoin people do. So it's like USDC, USDT, or DAI in the cryptocurrency world, except it'll be owned by the government, not by a cryptocurrency company. So Circle owns USDC, for example, and Tether is the owner of USDT. And those are two different companies that came in to create a digital dollar. The CBDC, the one by the government will actually run itself, or in our case, the Federal Reserve. Okay, very good, guys. So yeah, the lagging trade on the NASDAQ is Ethereum or Bitcoin for sure. The NASDAQ's greatly outperformed it because of all the hype about AI. So I would rather be in that than the NASDAQ. I'm not really comfortable shorting the NASDAQ because the macro conditions are really bullish for the NASDAQ. I just think it's a little ahead of its earnings multiples. So I'd rather play the laggard right now. Okay, very good, guys. Thank you so much, and we'll see you back next week.